Alrighty, now that we have the owner's earnings for CMT, we need to go back and compare this number to the EV and TEV. So I'm going to recalculate this again as an extra learning step. Just to kind of reinforce this entire process. You notice over here I kind of separated things out. EV is over here, TEV is over here. So, probably should put this down a little bit further. Okay, so we have the market cap. And again, if you remember how we calculated the EV and the TEV, I usually separate these things out a little bit more, but just for kind of simplicity's sake, I left things the same here, and to not waste waste your guys' time by having kind of rejiggering these things. So market cap is 160.4. And I'll get these, most of these calculations from over here. From now, this is just going to be short and long-term debt. I've already got the tabs open. Short-term, actually, let's get cash. Again, we're not on the trailing 12-month number here, so we need trailing 12-month numbers here because we want their most recent data. 27.5. 7.5. Short-term debt of 3, long-term debt's 7.5. 7.5, and again, we'll add these kind of numbers over here once we get to that point. For here, there's no minority interest, if I remember correctly. No preferred stock. So this is the calculation for EV right here. Yeah, just double checking. No minority interest that I see. Preferred stock. So EV equals, and again, you could even go a step further if you wanted to. You can make this red. So you need to subtract these. Everything you subtract, you can make red. Again, whatever you need to do, whatever makes is easier for you. And actually, the reason it's kind of awkward for me on here is I actually calculate this by hand every time I do it. So that's why I'm kind of improvising here. Every time I do both these calculations, it's by hand. I've never done it on the computer before, so at least to my how I remember it. So XG.4 plus, oop, I forgot to do that. I already forgot a step. So we need to go to the filings to find these numbers, to see if there are those numbers. And again, they're moving things around. I don't know how to get to their filings. There's usually a filings tab up here, or even here. There's usually tabs up here that you can click on, and they're all gone. So I will have to figure out how to get where they move. That's, I'm assuming, to print stuff. Where are their filings? So instead of doing this, since Morningstar continues to make things difficult, let's see if it's in the profile. Nope, but this brings us to their website, which will have their financial report. And from here, we again remember the things like operating leases, unfunded pensions that we're looking for in the total obligations calculations. These are in the annual report, which I was just above. Amendment 10Q, 15. Okay. Control F. Once this loads, operating lease. Okay, we want the final number. Once we go through the financials, we'll look at everything. We'll know exactly what everything is, but for this calculation, I just want the final number, which is right here. And you want to use, again, like we talked about there, and actually right here, we're going to use that as well. I'll talk about that in a second. So you want to use the most recent number, not the total number, not this number, not even this number. You want to use the most recent number because typically this is the most accurate number. These numbers fluctuate over time. Obviously, the longer you go, the less you know about what you're going to need in terms of things like operating leases into the future. So you want to always use this number right here, the kind of most recent number. So 539 times 7. So 3.8 million in operating leases. 3.8. And again, I'll add this after I get all these numbers, the unfunded pensions, I'll add this up here. We need to look for deferred tax assets as well. Before we get to that, this number, let's see, and anytime again I see this, go to note B, accounts payable. So I wouldn't include this because it looks like it's a short-term thing. Since a little bit, about 40% of this was recorded on the balance sheet as an accounts payable, so I wouldn't include this number. In some cases I would, but you just have to kind of use your judgment. If it's what I would use is if it's a long-term lease, kind of a 3 to 5 to 7 to 10 year lease that's not a capital lease, I would include and I would capitalize that number. If it's a capital lease, it's already been capitalized, it's already on the balance sheet, it's already should be considered in kind of this calculation, short-term, long-term debt calculation. It should be in some cases, or in many cases. Okay, so post-retirement benefits, that's not the number we are looking for. Post-retirement. We're looking for the actual asset or liability, not this stuff. Okay, not that, not that, because that's the current portion. Okay, so they have a liability of 7.9 million, so we need to add that. So now that we've done that, we can go back up here to this number, 3.8 and 7.9, 3.8, 7.9, so 11.7 plus 7.5, 23, 23.4 EV is, and again, most people wouldn't take this extra step in the EV, they would just look at TEV if they look at TEV at all. In my opinion, again, I want to be as conservative as I possibly can. I want to know about all this information, especially as a total business owner looking to invest in this company. So 160.4 plus 23.4 minus 27.5 is 156.3. 156.3. So their EV being lower than their current market cap means that this company could be slightly undervalued. This isn't enough to really make any sort of judgment call. And we'll kind of see down here further, at least again on a relative basis using these single metrics, if this is going to be a potentially undervalued company. And again, we'll continue using this once we get to the next week when we actually do intrinsic valuations. So, and the inverse is also true. If this number is higher than EV, it's one sign that the company could be overvalued. So 23, the actual number is 7.5 right there. So short and long-term investments. And again, I'm doing this kind of backwards from what I normally do. That's why we're kind of moving all over the place. No short and long-term investments on here. May as well, since we have this open, look. Yeah, nothing here. So deferred tax, and I don't put taxes or deferred tax assets or liabilities because I want the most clean numbers. Again, not there. That number right there, the 2.252 million, will likely be correct, but again, I want to go down here to see what exactly goes into that number. And there's always a footnote about this, which is right here. Let's see what this title of this is. Oops. Oh, went too far. So income taxes, yeah, there will always be a footnote in an annual report that looks similar to this, and then they have a bunch of kind of information down here. So there, blah, 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 blah. Okay, so as of 2015, they have after everything is said and done, after their assets and liabilities are added up, they have a negative 6.5 or $654,000 net liability. So this is important. I would note this, especially for this size of company, almost over $7 million of earnings that could become earnings in the future if they were to be repatriated into the United States. Again, they will likely, since they have a subsidiary down there, they will likely keep those earnings in Mexico and reinvest them. But again, I would keep note of that. Nothing really important here. If they were saying something along the lines of, we are thinking about repatriating this money, or if this was United States based net operating loss carryforwards or some kind of other tax credit, this would add extra value, but I don't see any of that here yet. Yeah, no. So I would leave that out. When this number is negative, I just leave it 0. Where are we at on the calculations here? Because again, especially when it's that small of a number, 0, 0, 0, just to be as conservative as possible. Because if it's a negative here and we subtract, technically we'd have to turn that to a positive, and that wouldn't make any sense because it's already a negative. So there is that. So their EV is 156.3. Their TEV is 160.4 plus 7.5 minus 27.5 plus 3.8 plus 7.9 equals, so their TEV equals 152.1. So, and again, I just thought of something. Duh, these numbers are different because these include these numbers right here. Just make sure you don't double count things and you add these kind of into this number. If you separate out like this, again, I usually calculate this by hand, so I wouldn't have to worry about that. But again, if you're going to calculate something similar to this, make sure you don't double count. Make sure you strip everything out. So this number is 152.1. Oh, and it just didn't save the decimal place. Oh, wrong way. So again, this number being lower than the market cap means it's one sign the company could be undervalued. So let's see. Now that we have EBIT, EV to FCF, EV to owner's earnings, now that we have owner's earnings. And then EBIT to EV, FCF, God damn it, EV, EBIT, and then same thing down here. So you got to add the T at the beginning. Paste T, T, T. Got really confused on this one. Okay, so now again, that's one sign. These two things are one sign the company could be slightly undervalued based on its current market cap. What we're doing here, again, we talked about this in a prior week. We're getting a relative valuations up here to see if the company is potentially undervalued on a relative valuation basis. And then down here, we're comparing those numbers, or we're getting from those numbers, we're inverting those numbers to get the approximate earnings yields from those numbers. So EV to EBIT is EBIT. Oop, I don't have EBIT on here. Duh. Get out of that. Get out of that. Quarterly. Oh, yep. And again, if you watch the last session, we have to add these numbers up again because they, for some reason, don't have the trailing 12-month number over here. So we got to get the add these 1.4 plus 3.2 plus 2.6 plus 3.1 equals 10.3 in the trailing 12-month period. So EV was what? 156.3 divided by 10.3. I'm just going to move the EBIT equals 10.3, so I don't have to recalculate that right there. So this number is 15.2. EV for cash flow, again, trailing 12 months, and again, for some reason, the trailing 12-month numbers aren't showing up on here. So 2.4 negative plus 1.6 plus 3.1 plus 4.7 equals 7. CF equals 7. OE equals 24. I'm just going to cut these, move them up 2 so there's a little bit of space, and bold them and highlight them just so we know there's what those numbers are. So 156.3 divided by 7 equals 22.3. 22.3. 26.3 divided by 24. So 6.5. Okay, so what if the numbers, usually these numbers are pretty close. They're within probably, I would say, 3 points of each other pretty much every time. What happens in this case where there's a huge difference in the numbers? All the way from 6.5 to 22.3. I kind of go with the average is what I would do. So I would add these up. 6.5 plus 22.3. And the average is about 14.7. So again, if you have done everything up to this point, you know, at least on a preliminary basis, that is, to me, is overvalued. I look for anything under 8. So let's invert those numbers though. So 10.3 divided by 150, 6.3, 6.6%, 7 divided by 4.5, 4.5%, and then 24 divided by 150, so 15.4%. Okay, again, if you've been following along, you know what these mean. You know that from my view, the only one that meeting this, my criteria, is the owner's earnings to EV numbers right there. Other two do not. The averages do not. So again, at least on this basis, this company looks overvalued. And again, we'll keep using the same company next week to kind of get an overall picture of how this compares to their intrinsic valuations. These are what we call relative valuations, which again, we'll explain more in further depth the meaning of next week. So TEV to EBIT, 152.1. 14.8. Divided by 7, 21.8. 6.3. Again, same thing here. Only metrics on this preliminary or on this basis that will meet my criteria will be this one. So 0.3 divided by 0.1, 6.8, 6.8. 6%, and 24 divided by 15.8%. I do that every single time I try to find the decimal or fix the decimal place. I do it the opposite way every single time. So you may be thinking to yourself, if owner's earnings, especially since we just came off the owner's earnings topic, if owner's earnings is kind of, at least to many value investors, the most important metric and true economic earnings, why don't we rely on just this one metric? This is why. We want to get the whole look of the entire company. We want to look from an operational perspective, which is what EBIT is. We want to get from a free cash flow perspective, which is all the money left over after everything, including capital expenditures and taxes. And we want to, from an owner's earnings perspective, figure out how profitable the potential investment could be, and how potential or how undervalued or overvalued or fairly valued the company is, at least on a relative basis. That's all we're trying to figure out here with all these numbers. And why with like anything, why I don't rely on one metric for anything. Doesn't matter how powerful the metric is. The only kind of rule that breaks this is shift too many cells down. Again, this is just me being a little OCD right here. The only kind of thing, again, and I've talked about this a bunch, that breaks the only kind of metric or thought processes or whatever, investment thesis, whatever, during this entire analysis that we're doing of these companies in a real world sense, that will kind of make or break the entire analysis off that one metric or thought process, is if I can or cannot trust management. off the top of my head, that is the only thing the only kind of single thing that I will say yes or no. This is a make or break decision. And most of the time it's a no. I don't look at a company saying, oh, this management is so trustworthy, I'm going to specifically buy them because their trustworthiness. But the opposite is 100% true. If I don't feel I can trust company's management, I will not buy them under any circumstances, no matter the undervaluation, no matter the potential opportunity, whatever. And again, even going into that kind of evaluation about management, a lot of factors go into that. ROIC, ROCE, unlevered return on net tangible equity, the amount of free cash flow the company is producing, the number of patents the company has, the honesty of the management if they're having problems, the vision of the management, those and more qualitative things like that when it comes to the financial reports and the filings. Are they using company money to their own benefit, or are they looking out for best interests of shareholders? So even though that one metric, the trustability of management, can make or break an investment, in my opinion, there's a lot of information that goes into that judgment. So even then, the final thing, or the final kind of judgment, yes, that one thing can make or break the investment, but there's a lot of different information, different thought processes that go into getting that information of if I can trust management or not. So now, what we've done here, we're done with owner's earnings. We're done with all the profitability metrics. Now, last thing to do before putting all this together, go into week 6. And again, before I even get to week 6, if you have any questions about owner's earnings, unlevered return on net tangible equity, any of these relative valuations we just did, how to calculate owner's earnings, anything in this week, bring it to the live Q&A. Talk to me about it in the Facebook group. Tag me in a post in the Facebook group and ask me a question about it. Get a hold of my team and let them know that you have a question for me, and I will get back to the question. Get a hold of me somehow, because again, we're getting to the final stretches here before we put everything together next week in week 6, the final week of this value investing masterclass. And in week 6, it's all about relative valuations. Again, recapping all these and explaining a little bit further what relative valuations, what we're exactly doing with relative valuations, and then getting into actually real world different valuation techniques. I have them written down here, including the relative valuations and earnings yield valuations that we've already talked about a little bit. 1, 2, 3, 4, 5, 6, 7, 8 different valuation techniques, and then we're going to put it all together, and then by the end of this course, by the end of next week, you'll be ready to evaluate companies fully on your own and make buy or sell investment decisions fully on your own. So we're getting close. Again, if you have, at this point, if you have a little bit of extra time and you finish up the content in this week, and you feel comfortable with it, go back to previous weeks and catch up on anything you have questions about there. Find any questions you have for me in this, and ask them in this week's live Q&A or in the Facebook group. Again, we're getting close to the end of the program, and I want to hit next week hard, because next week, again, is all about valuations and actually doing real world case study valuations on real world companies.